if you or somebody you know is going through a divorce and there is either current real estate or future real estate involved, this is a call and a webinar that you're not going to want to miss. I'm super excited to introduce and bring on the screen with me Michael Alvarez and Josh Beretta. And they are both with Beretta Law. Welcome, you guys.
Hey, Kelly.
Hello, hello.
Thanks so much for agreeing to just share your insights. And, you know, I've been a mortgage lender for over 27 years, and divorce is a very real thing. And I know it's your world, but even on the lending side, we often see people that have gone through the divorce process, it's finalized, and then they come to us, and either that's needing to refinance or they want to buy a new home. And there's so many things that go into that ability to get pre-qualified. So thank you so much for agreeing to kind of just chat with me today. And let's kind of dive into some of these things that people need to be thinking about, and especially if they think that they need or want to finance with a home loan downstream. Does that sound fair?
Absolutely.
Okay, cool. One of the most frequently asked questions that we get, which obviously we're not giving legal advice, but it's with people saying, hey, I purchased a home with my spouse. I am not on the title, but so therefore I've disclaimed. Walk me through what that really means in a community property state, because I've had attorneys say, but that doesn't necessarily mean, even though they disclaim their interest, it doesn't necessarily mean that there isn't some ownership. Kind of, can you walk through that on a very broad, generic level? Because it is confusing. You know, if they're disclaiming their interest, is that really disclaiming their interest?
And then, Kelly, I think the confusion that you're facing, other professionals face, is the Court of Appeals has gone back and forth. Supreme Court's gone back and forth on these things. So if you were talking to someone a year and a half ago, 2 years ago, it would have been a different answer. So essentially, historically, it was if a party signs a disclaimer deed, they have actually disclaimed their interest in that property and in that home. Okay. So what that means is they would not be entitled to a 50-50 equity split. Essentially, they wouldn't sell it and get half that if they disclaim their interest. Okay. Now, I believe it was about 2 years ago, there was a Court of Appeals case that came out and said, we're not going to uphold disclaimer deeds for married couples, essentially. So this was a big kind of shock to everyone. But then the Court of Appeals reversed that and went back and said, no, they're disclaimer deeds. We need to uphold them. So it was kind of I'd say year and a half gap where things were a little bit wonky and disclaimer deeds really didn't mean anything. So if you were talking to someone in that time frame, then that was correct, right? Now, most of the time what I see with the disclaimer deed is a financing person says, hey, your credit's bad, or you have something in your past. We can't qualify if you're on the loan. So it's only going to be in this party's interest. The other person needs to disclaim their interest. Okay. Now, the Court of Appeals case law on that is pretty clear that even if that's the purpose, is that one party has bad credit, and I believe they call it for financial reasons or something like that, they're going to uphold that disclaimer deed. Okay. So this is the current lay of the land. They're going to uphold that disclaimer deed and say, it's not your house. So whoever, and that's even if it was purchased during the marriage. Now, and I'll let Josh talk about this, there's what's called a community lien interest in that home, which again, I always tell people it's nowhere near 50% of the equity. It's really based on principal payments and things like that. But that is the current lay of the land here. So anyone that's watching this that is still married or is, in the future, just know if you sign a disclaimer deed, it's going to be extremely hard to get out of that. You'd essentially have to show fraud, undue influence, coercion, which is a very high standard. And most judges are going to say, no, disclaimer deed, you're done. But I'll let Josh talk about the calculation, that community lien interest.
Yep. So like Michael stated, there is a case that's kind of on point with the lien interest. So there's a difference between, who is on the title, who's sold in separate property that real estate is, versus do I have value in there because I lived there for however long. And I guess, kind of bird's eye view, again, kind of looking back at the policy of that, it makes sense to me. Some people, it doesn't make sense, but it makes sense to me that when you're in a marriage, you're supposed to be building wealth, coming together, combining incomes, that traditional role that a lot of people utilize during a marriage. When you do that, the last thing on your mind is, I need to go purchase an investment property separate and aside from my spouse to make sure that I have an investment or retirement nest egg in addition to what we're creating together. So with that being said, say you are that spouse with that, that poor credit or that bad collections from, 2011 that's stopping you from getting the mortgage. You're in a position where you can still gain interest and equity into a home, even if it's not your titled property, right? So with that being said, really, it's just a case in Arizona. Again, it's the Dreyhus case. Dreyhus was just the name of some of the parties involved in that case. And the Court of Appeals used that name as Dreyhus formula. And with that, really, it's just a formula where they look at what the property was purchased for, what year was purchased, and then the appreciation of that property, and then the principal amount of the property. And there's just a pretty simple calculation that they utilize to determine, okay, this is what this spouse could be entitled to. Now, as far as it's not 50-50, when we run them, it's different because everybody's principal is different from everybody's equity as it pertains to the interest rates that was assigned to that mortgage. So when we run them, I see generally between, I'd say like a 15 to 20% split versus a normal 50-50 split, depending on how long the marriage is, of course. So again, it gets pretty dicey when it comes to that calculation. It's often, Michael and I, again, we don't claim to be mathematicians or financial experts when it comes to real estate or valuations, because what we normally do is we'll hire a forensic accountant, somebody that can do the calculation and be able to argue that on somebody's behalf in court if need be and testify. The issue that we see, though, is, my client will go seek an appraisal to try to get the highest amount. Their client will try to seek an appraisal to get the lowest amount. So then we start having competing appraisals, competing financial experts, and then competing valuations. I'll tell you in general, just like with Michael said, if there's not an agreement, the court will order the sale of the property, and the sale in value will be the fair market value of what it sells for. That's easy as day, right? That's it. Or the court will say, if you have this value and this value, we're just going to split it right down the middle, right? This is the half range is going to be what we value the property at, and then we'll use the calculation from there.